Everyone, and welcome to our online series, Adoption for Disruptive Innovation in a Volatile Market. Before I pass it over to Jack and Cathie, I just want to go over some upcoming events for CFA Atlanta. The first I just want to highlight is on April 12th. It's called the Masters of Private Credit, How Market Leaders Are Allocating Their Capital in a Rising Rate Environment. And that's going to be a panel discussion at the Buckhead Club from 12 to 1 p.m. We're really excited about that event. The next one is an online series. It's a fireside chat with Sarah Malik on April 20th from 4 to 5 p.m. And then we also have another online series on May 17th. It's called Some Potentially Surprising Facts About Long-Term Stock Returns, and that's from 12 to 1 p.m. Please check our website for more details on these and other programs, and please register today. Really excited to be joined today by Cathie Wood. She's the CEO and CIO of ARK Investment Management, and Jack Stock, Vice President, ARK Product Specialist, and with Resolute Investment Managers. Just a quick housekeeping note, please submit your questions via the Q&A feature within the Zoom controls at the bottom of your screen. And with that, I'll turn it over to Jack to begin. Thanks so much.
Thank you, Charlie. Thank you, everybody, for taking the time to join us today. It is greatly appreciated. As Charlie mentioned, today we are joined by Cathie Wood, CEO and CIO of ARK Invest. With over 40 years of experience identifying and investing in innovation, Cathie founded ARK Invest to focus solely on disruptive innovation. Through an open approach that cuts across sectors, market capitalizations, and geographies, Cathie believes that ARK can identify large-scale investment opportunities in public markets resulting from technological innovations centered around DNA sequencing, robotics, artificial intelligence, energy storage, and blockchain technology. Prior to founding ARK, Cathie was CIO of Global Thematic Strategies at AllianceBernstein, managing over $5 billion. Prior to AllianceBernstein, she was co-founder of Tupelo Capital, where she managed $800 million in global thematic strategies. And prior to that, she was 18 years at Jennison Associates as chief economist, equity research analyst, portfolio manager, and director. She started her career at the Capital Group in Los Angeles as an assistant economist. So thank you again for taking the time to talk with us today, Cathie. I'd like to start the conversation today kind of very focused on what's going on in the market right now. I know that this is something that we have been discussing at ARK Invest for some time, the strain that could come with aggressive rate hikes from the Fed. So just putting it out there as an open point, what are you seeing? What are you thinking about what's going on in the banking space today?
Sure. Thank you, Jack. And thank you, Charlie and Cathie from the CFA Society of Atlanta. We're delighted to be here. Yes, the elephant in the room. What the heck is going on out there? Well, I'll just set it up first by talking a little bit about our concerns that started last spring. And, because we are so transparent, if you're interested in some of the things we were saying last spring, you'll find what I was saying on Twitter. The first thing we noticed in the spring last year, as the Fed was lifting interest rates, was that credit default swaps, so insurance policies against bankruptcy, those started moving up in price. And basically telegraphing that the odds of bankruptcies were going up, and they were going up fairly dramatically, and we were puzzled at the time. The yield curve inverted for a very short time in April. We seized on that and said, "Wait a minute, something's going on here." It then moved into positive territory. But in July, the yield curve inverted, and it kept inverting, or the inversion got deeper throughout the year and into this year. In mid-October, we wrote to the Fed. So the Fed had been raising interest rates 75 basis points. I mean, aggressively raising interest rates. And we wrote to the Fed and just asked the simple question. You know, we had credit default swaps going up. We had the yield curve inverting, which typically leads or is telegraphing there's trouble out there somewhere in the economy. And commodity prices had started down. We had the war in Ukraine. Oil prices went to $130, but were coming down fairly dramatically. And so our question to the Fed was, how can you be unanimous in this vote to be so aggressive in your monetary stance when we have this conflicting evidence accumulating here? And around that time, the bond market bottomed out. So interest rates peaked at around on the 10-year Treasury bond yield at 4.3%. Asset allocators had been running away from the bond market because we were in the midst of the worst bond rout since the 1700s. And we had people like Larry Summers and Mohammed Al-Arian really goading the Fed and saying, you have to keep raising aggressively because this inflation problem is not going away. And we had taken the stance that this inflation problem was not a 70s style inflation problem. 70s style inflation started brewing in 1964 with the Great Society social programs and the Vietnam War, so guns and butter. And the Fed accommodated that as well as the closing of the gold window and the quadrupling of oil prices. The Fed was accommodating everything. So that inflation was brewing over a 15-year period by the time Chairman Volcker got to it. This problem, remember, we thought we were going into depression, or many people thought we were going into depression. We did not. We were actually expecting a V-shaped recovery. But the Fed was expecting that interest rates would remain low through 2023, if you look at their forecasts, really almost near zero. So it's not surprising that banks were deciding in the midst of the crisis, when stimulus money was gushing into the various banks, they decided to put it into long-term, very safe instruments backed by the government, yielding in the case of Silicon Valley Bank 1.6%, in the case of Charles Schwab 1.7%, and then we moved into an environment where the Fed started worrying about its legacy. Was it going to be the Fed that has taken the inflation genie out of the bottle? We don't think it is. We think the risk is, from here on in, more on the side of deflation. We think that investors are going to be surprised dramatically by how low inflation and interest rates go during the next few years. And we believe that we're set up for a hard landing. I think we have a lot of economists tiptoeing around this, but we just use a very simple equation that you may remember from your economics days. MV equals PQ. PQ is nominal GDP, so price times quantity. And MV equals money times velocity. Okay, well, money, M2, for the first time since the Great Depression, 1930s, money growth is negative. It looks like March it will be down 3%. For the quarter, it'll maybe be down 1.5% to 2%. That means that on a year-over-year basis, in order to get to what we believe is 5.5% GDP growth, velocity has to increase, which it has in here. It has, but we think the crisis changed that. And now we think the velocity of money, when I saw lines around Silicon Valley Bank, these are tech specialists. They're used to working online, and here they were going to the bank to pull out their money. When you see that sort of activity, what it usually means is consumers and businesses pause, or they pull back and say, wait a minute, I have to see what's going on here. The proverbial putting some money under the mattress occurs, maybe not technically today, but it's that mentality. So you're not going to spend that money. So we think the velocity of money is going to come down and sequentially, and could hit negative late this year. That would be a hard landing unless the Fed eases dramatically. And we do believe something else is going to force the Fed into the very first pausing, and then pushing down interest rates as we get into the second half of this year.
Excellent, excellent. And just to clarify, you mentioned MV equals PQ, and your concern here is that M is already negative,
Yes.
and it appears that V is going to go negative in the relatively near term, meaning nominal GDP will likely be negative.
Could be negative. Now, on a year-over-year basis, I think that the velocity is, I'm looking at it sequentially. It looks like it's flattening out now and will decline on a sequential basis. So yes, it's going to be a huge headwind to growth.
Wow. Wow.
But I will say, Jack, why are we so excited about our strategies in this kind of an environment? And the main reason is innovation solves problems, and corporations are going to have big problems here, much of them margin related. They're going to have to figure out ways to become more productive, create new products and services that are more creative, become more efficient generally. Many companies are focused on that issue in our space, making companies more efficient. And with artificial intelligence, the opportunity to do so is enormous. We think the productivity gains we are going to see, if companies harness artificial intelligence the way we think they will, the productivity gains are going to be provocative.
Excellent, excellent. So AI stands to potentially be one of the solutions for the current problems that we're facing. Are there other areas that you would say are likely to benefit from what's going on in the banking space?
Yes. So AI actually is going to it's going to cause the convergence between and among technologies. We believe there are 5 innovation platforms evolving today, and they involve 14 different technologies, many of which are converging. So we're looking at S-curves feeding S-curves. So in the world of mobility, transportation, we do see in evolving here, and it's no longer if, it's when, because we've already have proof of concept with cruise automation in San Francisco and now in Austin and Arizona. We're going to see autonomous taxi platforms. I know Elon Musk thought they would be here 3 years ago. We originally thought they would be out last year, that they would be able to roll out last year. But it does seem, judging by a video from Scotland, that Tesla is now believes that we're about to move into prime time for liftoff of autonomous vehicles. And that form of transportation, we think, is going to price below Uber. And because as it scales, the costs will drop dramatically. So again, transportation is a very big business cost. And so we think that we're going to see logistics impacted not only by AI generally, but transportation specifically. So the convergence of the digital and the physical world within transportation. You'll notice that the as the regional banks were imploding in the teeth of the crisis, and I hope we're through with it. I think the liquidity crisis is coming to an end. I'd like to see the KRE, the regional bank index, bounce a little bit more. So the liquidity crisis is easing. The KRE, which is the regional bank index, is not into a V-shaped recovery. So I'm not going to trust that that the monetary and fiscal authorities have their arms around this liquidity squeeze, so we can't declare victory. But at least half of the solution is understanding the problem. I think everyone now understands the problem. And we can go into what that is, the banking crisis, if you'd like. But what we found from an innovation point of view, so interesting. The Monday that the president gave his speech at 9 o'clock before the markets opened, Bitcoin and the pre-market was down. Bitcoin got down to $19,000. And as that day evolved, it started moving up. And it's now at $28,000. So what does that tell you? Flight to safety. Bitcoin, unlike banks, Bitcoin is a highly decentralized network and therefore very secure from a technology point of view. It is totally transparent. Now, it's pseudonymous, but you can see every transaction taking place within the blockchain, and it's auditable. You can track the changes. So I think that Bitcoin and other crypto assets have become a flight to safety vehicle for those people who really understand what blockchain technologies have to offer. After all, Bitcoin was born out of the 08-09 crisis because Satoshi Nakamoto, whether a man, a woman, or a group, we don't know, but in their wisdom, they said, we need to bring more trust into the financial services ecosystem. So let's just put in this layer, which the internet has been missing ever since it evolved, because no one thought commerce would ever take place on online. I remember in the early days of the internet, no one was going to put their credit card online in the early days of Amazon, and look at us now. Well, what this will do, and just to give you much of the innovation that we're talking about is around efficiencies. Right now, if you use the traditional financial system, the steps needed to get a merchant, for a merchant to sell to a consumer, there are 9 steps. With this, we call it DeFi, decentralized financial services, but it's really just internet financial services. We're going to take the toll takers out and drop the process to 2, merchant to consumer. It's going to save a lot of fees, and I think it's going to be adopted now more rapidly because, again, businesses and consumers are looking for ways to save money. They're a little scared. They're willing to change their behavior in a crisis, and that's when innovation takes hold. And I'll mention another one. I think a lot of people have been surprised to see how quickly electric vehicles are taking off now. Last year, electric vehicles were up. I think this is a US number, but it could be globally. And maybe Jack, from our Big Ideas report. By the way, Cathie Wood has posted our Big Ideas deck. It's 153 pages, but a lot of what I'm talking about right now is illustrated in there. Last year, electric vehicle sales were up 65%, something like that, while gas-powered vehicle sales were down 6 to 7%. Why is that happening? Well, you've got companies like Hertz saying, I need to buy some electric vehicles for my fleet. because the maintenance costs associated with electric vehicles are 50 to 60% lower than for gas-powered vehicles. That's one of the reasons. And the other reason is when consumers really do their homework, the total cost of ownership of an electric vehicle is lower than that of a gas-powered vehicle, apples to apples. So
Yeah,
those are,
and just to jump in with the numbers, it is 62% year-over-year growth and a 7% drop. That's a global number. So just wanted to interject that real quickly.
Sure.
Now, on this note, I would ask, we constantly talk about cost decline curves, and I noticed that the cost of lithium has been dropping quite rapidly. There's probably a bigger story there associated with, supply chains and regulations, but certainly seems to bode well for cost declines in the EV space. What are your thoughts?
Yeah, I think a lot of the concern around electric vehicles was, well, how are we going to get the raw materials quickly enough to make this happen? Whenever I see the Chinese and the Koreans vying for a new market, I know that the build out is going to accelerate. And, they have started focusing more aggressively on battery technology. So that was one clue. It takes 3 years to get a lithium mine up and running. Tesla about 5 years ago was going around to the lithium producers and basically saying to them, if you commit to a mine, we will buy all of your capacity. So that got the ball rolling. And I think we probably are going to be surprised at how quickly lithium prices decline. They increased tenfold from, I think it was late 20 to late 22.
Yeah.
2 years. And by some metrics, they're down 10%. Others I'm seeing down 40% already. And I think this is going to prove true of many commodities. That's why I think we're going to, that they are going to reinforce this idea that we're going into a deflationary period. Why? Because after COVID, when the V-shaped recovery surprised people, they started double and triple ordering. Businesses started double and triple ordering, fearful that they were going to lose business. They just couldn't get enough inventory to satisfy consumer demand that had been stimulated with government stimulus. And so we saw a lot of double and triple ordering. And I think what has shocked me in the latest GDP report, the fourth quarter of 22, I expected businesses to try and clear the shelves of excess inventory with massive discounts. And we did see those discounts. Maybe they weren't broad-based enough, but the shocker to me was inventory accumulation actually accelerated in the fourth quarter of last year. One of the reasons for that is companies were trying to preserve their margins by increasing prices, and the consumer railed against it. And a really good example there is Procter & Gamble, a staples company. Their pricing, I think, was up 9 or 10% in the fourth quarter, and their volumes were down 6%. Now, this is a staples company, so they rarely see that kind of volume decline. So it was probably a bigger drop than they expected. And while their inventories are not as bad as they were, they are getting them under decent control. Others are not, with the same strategy of pricing up to try and salvage margins. So it's an interesting dynamic. And I think that the consumer saving rate is near a record low now. I know a lot of people are focused on the savings that are still in the system because of the stimulus payments. I would say don't hold your breath that those are going to be spent. And the reason is we're coming to the end of the student loan moratorium. I think that those loans, they'll have to start paying them back sometime this summer. And that's a big hit. It's a big hit, especially after getting used to spending a little more than otherwise would have been the case during the moratorium.
Certainly, certainly. And you make a great point about student loans because, that's a large consumer block. These are people who are educated, making good incomes, and suddenly they lose a part of that and less discretionary spending, so to speak. Well, I want to stop and just focus in a little bit more. You talked a little bit about electric vehicles versus internal combustions and what the trends look like there. And looking back at 2022, it felt like there was a lot of progress that was actually being made in the technologies that we're offering exposure to. Unfortunately, the market was essentially running away from anything associated with duration. Can you talk to us a little bit about some of the innovations that happened in 2022 that you think people should be excited about?
Well, I think in the fourth quarter, ChatGPT was released and in beta, and it didn't get much traction. So boy, was the fourth quarter bleak for long duration oriented equity managers. Bonds started to improve, but and usually our strategy improves in tandem, but we didn't get our Santa Claus rally because I think a lot of allocators were caught flat-footed by that peak in bond yields in the middle of October. So they were reallocating to bonds. And it was very dark days. So we didn't hear much chatter about ChatGPT, which now has captured the consumers and businesses' imaginations because it's so provocative and so helpful. You have to worry about hallucinations. If we could talk about that, they're error prone unless you give very specific prompts that orient ChatGPT. So the productivity gains that we expect out of artificial intelligence are going to be astounding. And ChatGPT has finally given people, we've been talking about this for a very long time, finally given people a peek at what we're talking about, and may have inspired along with the idea that we're probably nearing the peak in interest rates, may have inspired a resurgence in our kind of strategy, a long duration equity strategy. That's one. What I found fascinating last year just seems so bleak. Nobody was paying attention to one breakthrough that was so inspiring. A young girl, 12 years old in the UK, Alyssa, in May of last year, had gone through dozens of therapies to treat her leukemia. And her mother was building a necklace for every therapy. She just knew one was going to work. So a bead, and soon this became much more than a necklace. They were just dozens of therapies. And so she was ready to be sent to hospice. And they threw a Hail Mary pass. Researchers at a children's hospital in the UK, the parents were willing to let Alyssa be treated with experimental base editing, which is gene editing. And they said, yes, anything. And by November, she was cured. And, that's like unbelievable. Did I hear anything? Did anyone here in the United States hear anything about this? I had to go to Asia and hear the BBC in Asia talk about this breakthrough. And I called back to our analyst, Ali Ehrman, our therapeutics analyst. I said, and she was at what is it? It's ASH, right? The American Society of Hematology. It was a conference, takes place in December of every year. And so I called her and she was there. I said, wow, this must be making a really big splash. She said, no one's talking about it. I said, isn't there a poster? Isn't there anything? She said, yes, there was a poster. No one's talking about it. And I thought to myself, wow, just think how negative the psychology is out there. If we were in a bull market, that would have multiplied the gene editing stocks. They probably would have doubled all of them on that. American Society of Hematology, that's blood. This was a blood disease. And so I tweeted about it and said, guys, isn't anyone paying attention to this? So it just gives you a sense how negative the psychology is, which is a good thing. It's a good thing. We're not in this crazy bull market. The other thing that we know is the B of A Merrill Lynch cash survey. This is retail investors. It's near its record high. And I just read this morning, mutual funds have been building cash for 15 months. Hedge funds are at their lowest exposure to equities. It says 19th percentile in terms of, I don't know over what time period they're comparing, but nonetheless, it's a statistic corroborating that fact. And then CTAs, commodity trade, I've forgotten what the A is all about. They have gone from something like $200 billion net long and bullish to now net short. So the banking crisis has put, has put tremendous fear into the market. And, to see our strategy weathering that the way it has is giving me hope that the market is seeing the end to interest rate increases. And Jack, just before I finish on interest rate increases, I do want to set up something that I should have set up at the beginning when we were talking about macro. And I see some of the questions are about macro. So the banking crisis happened for two actually understandable reasons. They're understandable because they're so rare. And so the assumptions that you would have had to make to avoid the crisis are assumptions that have either never happened or haven't happened in 50, 60, in the investment lifetime of most people investing today. The first was that interest rates would go up 20-fold, or would not go up 20-fold in the span of a year. Of course, many banks had locked down during COVID. The Fed said it was going to be very tough to get out of this. They had locked down those 1.5, 1.6% interest rates. That 20-fold increase compares to Chairman Volcker's 2-fold increase, 10 to 20%. And many people brushed aside when we were saying, wait a minute, this is going to be a major shock to the system, this 20-fold increase. And many people brushed it aside. Oh, we're starting from such a low base. That was the point. And that base had been very low for 12 years. And so there was an expectation that it would remain low, that the Fed was reinforcing. So that's the first reason. And the second mistaken assumption was that deposits would not outflow. Very rare. I think the last year over year, we're still getting conflicting data on this. The last year over year decline in demand deposits was in 1948. Wow. And I should say of this size, meaning on a year over year percent change basis. The last time we've seen negative M2 growth on a year over year basis was in the 1930s, the 1920s, the Great Depression. So we're getting a lot of Taylor rule questions here that Fed funds, should be up at 11. And of course, that's what Larry Summers and Mohamed Alarian and others were running with, and Chairman Powell. I think the right thing to do when there's uncertainty and conflicting evidence is to look at what the bond market is telegraphing. The bond market is the market, rightly so, that should be extremely sensitive to inflation, right? If we've got a 3.5% to 4% long-term treasury yield and inflation, the risks that economists see out there is are in the 6 to 8%, get used to it kind of range, they'll be selling those bonds and interest rates will go up. Well, they weren't selling them for some reason. Starting mid-October last year, risk aversion started to take hold, and the bond market started to rally. Maybe because the bond market was looking at default risk, because that's what it spends a lot of time doing, and began to worry about the banking system, which was suffering from deposit outflows. And I think the Silicon Valley Bank case, that those deposit outflows were not because of competitive money market funds. They were because we were in a venture capital funding drought. And these startups weren't able to enjoy liquidity events. And so they had to start draining deposits to fund their businesses. And that got the ball rolling. And I think the most dangerous thing about this crisis, and I used to say we're still in it to some extent, at least we understand it now, is that many people are now, they're looking at their deposits and they're looking at how much they're making on deposits in a regional bank. And they're saying, okay, I'll leave only 250,000 in this bank and I'll put the rest in money market funds, treasury funds. So I will get this CFAs. I will lower my risk by leaving the banking system and increase my return by moving into treasury assets. Think about that. That is dangerous. That's a flight to safety. And so I would answer the Taylor rule question by saying, and I wish the Fed would do this, respect the market signals, respect the market signals like credit default swaps, inverted yield curves, and the actual bond yields themselves, and the inflation projection in the bond market, which is 2% for the next 10 years. The Fed does not respect the markets. And I think the reason, and that's not an insult, they just don't have many people who have worked in the markets and actually put money to work, or have run businesses and been unable to get money. So I think we need more market-oriented people included on the Fed now. Instead, they're hiring, Goolsbee, who's been an economist. If you look at who these people are, as Art Laffer said to me on an In the Know webinar we did, it's on our website. I said, how could the Fed be making these mistakes? And he said, because it's being populated by people who look like, the average individual that people can relate to, lots of diversity and all of that. We need real business expertise, they've been in the real world. Larry Summers hasn't been. Mohammed Alarian might claim he has been, but, he's always been a statesman-like figure. He hasn't been managing the money and watching the signals. And he hasn't gotten burned, actually lost money for other people, which is the worst thing to do. And I realize I'm saying that in the face of our very difficult performance in the last couple of years. But we need people who have had those experiences on the Fed and who can recognize a red alert when they see it.
Certainly, yeah. Sometimes what's going on from the ground up is very different, where the tire hits the turf, so to speak. So, well, now that we're kind of looking at some of the questions that are coming in from the audience, should we take a moment and go through some of these? I think there's some interesting ones here.
Well, I'm sorry, Jack, I see that. And since we just talked about the Fed, this question from Robert Thompson, it's definitely a difficult environment to invest and manage in as the Fed battles price and financial stability. This is another issue that I have with the Fed, that they are putting these in two different buckets and saying, well, for financial instability, we have tools to take care of that. But at the same time, we have to fight inflation. These two things are linked. The bond market is saying you've done too much. And let me give you an example of what I mean by that. Again, someone who's been in the market for 45 years. If you look at the yield curve, the week before the crisis, it was inverted by more than 100 basis points. And finally, the financial press, began to focus on that and say, oh, the last time we were here was in 1981. In terms of the absolute number, that is true. But we believe that the Fed is 4 times tighter today than it was in 1981 when Volcker was strangling inflation. How so? Well, an inversion of 100 basis points or 1% on a 4% bond yield, 1/4 is 25. If you go back to 81, where were interest rates? 15%. 1/15% is more like 6.5. Now, if you use Richter scale analysis, that is 6.5, an earthquake. I know what that feels like. I was in 2 earthquakes of that magnitude, and they are scary. Well, 6.5, I've just told you, versus 25. I don't think there even exists a 25 on the Richter scale. That would be total demolition of in many cities, could be even countries. I don't know. So, I think the Fed is playing with fire, and it still doesn't understand because it's talking about interest rates going up again. But the market is going to whip it into shape, I think.
Well, certainly we hope that things get figured out sooner rather than later. I've been talking a lot about terminal rates with investors, and we're hoping that we're getting closer to that. All right, excellent. Well, I do think some of these questions that have come in are worth kind of talking about, a little bit more focused on innovation. One that came in from Nicholas Romello. How do you think the lack of repairability and recyclability of EVs could affect the growth rate and market penetration of EVs? And do you think that these issues are going to ease over time?
Well, it's astonishing to hear, and Elon Musk has said this, that Tesla right now is recycling 90% of its batteries internally. It's reusing them. And in terms of some of the more problematic materials like cobalt, it has designed cobalt out of its future batteries. So, Tesla, when it sees a problem, it works around it. It's a true technology company. And in terms of, let's say, these batteries, which we think are going to last more than 1 million miles, they're on track to last 1 million miles per car. When they are done, when they hit that and the performance degrades from a driving point of view, in order to recycle the entire battery, we have done some work on how Tesla could Tesla could arrange for its cars or its batteries, just its batteries from the cars, to be sold into the utility ecosystem. And we've done a study that shows that the residual value of a battery from a Tesla car will, just the battery, not the entire car, it should be higher right now than the residual value of a like-for-like Mercedes, not electric, but gas-powered. And why is this? It is because a utility is going to be able to take that battery or groups of those batteries, and instead of needing to build more peaker plants, which are very expensive, but are only used for 5% of the days that are extremely hot or extremely cold. Instead of having to build a whole new peaker plant, they could put these batteries into their existing ecosystem and also accelerate the build out of solar and wind. So that's a win for the environment and a win for the utility in terms of capital costs. So we've thought carefully about this and done a lot of research on it, and are quite satisfied with the answers we've been coming up with.
There's a compelling article that we posted on ark-invest.com from Sam Corris that goes through this in greater detail. And I would also let everyone know, if you want to rewatch the investor presentation that was done by Elon Musk, he talked a lot about kind of the mining overhead and how scaling electric vehicles will actually reduce our dependency on mining and pulling things out of the earth. So, it is definitely something that's being watched very closely. All right, another question that I think could open some eyes here is from Anonymous. I understand how ChatGPT can enable productivity, but I have also seen use cases that are not using ChatGPT well. When will ChatGPT hype turn into meaningful innovation? And is the general hype going to prevent viable use cases from getting the necessary attention to enable adoption?
Well, it's very interesting. Today, Elon Musk, Steve Wozniak, and a number of people involved in not OpenAI, but the movement, the AI movement, signed a letter and said, whoa. We have to slow down and have a 6-month moratorium because AI is absolutely taking off and it's unstoppable. It's unbelievable what people are starting to do with it. But specific to this question, we have, if you were to sit in on our brainstorm on Fridays, you would be privy, and you are welcome to sit in if you would like. You would be privy, because we do it by Zoom, to our very lively debate on AI. And as we were learning more about ChatGPT, the first question was, oh my gosh, this is going to ruin education. The educational institutions are going to be destroyed by this. And I think when you use ChatGPT, you realize its weaknesses very quickly. If a student wanted to write a 5,000-word essay on the history of space exploration, that ChatGPT would spit it out in less than 30 seconds. And the citations and the language would be fantastic, especially if you direct it to write in a certain style. But if a student turned that paper in to a professor, within reading the first paragraph, the professor would give the student an F. And the reason is because ChatGPT, it scrapes from the internet, from the beginning of time, of the internet time, that is. And it only goes up to the end of 21. And there have been a lot of breakthroughs in 22 that I would miss, number one. But number two, yes, there are lots of correct facts and figures, very interesting and comprehensive. There's also misinformation, and there's also a lot of creative content around space out there, science fiction, which is, part of someone's imagination, but really never happened. And the citations are usually, they look good, but they're full of errors as well. So I think with that example, we can see the weaknesses in ChatGPT. However, we are going to see evolving a job description, prompt engineer. So critical to the productive use of ChatGPT and other and successors, we think, is going to be the text prompt that you put inside. We're all going to become programmers, or could become programmers, because this is just natural language, right? But you do have to refine it, and if you're using it in business, you'll have to have domain expertise to understand what question to ask. So I think it's going to be, we often say artificial intelligence is really augmented human intelligence. And I think this will be a good case in point.
Excellent, excellent. And you touched on something that right there that I think is incredibly profound. The idea that the data that's being used to train ChatGPT is essentially scraped from the internet. And one thing that we talk about at ARK Invest is the highest quality, most robust data set is going to be what ultimately leads to the best artificial intelligence. Do you have any thoughts around, high quality data sets and what the opportunity is there?
Yeah, and many people look at our portfolios and say, the flagship portfolio doesn't own the names most so closely associated with ChatGPT, and that's Microsoft and NVIDIA. And there's a reason for that. Those are check the box artificial intelligence companies, and they're big beneficiaries, to be sure. Microsoft still has a lot of legacy that it has to work through in terms of tech, but Satya has been doing an amazing job, and all credit to him. And of course, NVIDIA is picks and shovels, but they're priced accordingly. The stocks in our portfolios are the companies that most investors don't understand how valuable their data is. I often talk about Teladoc building the healthcare information backbone of this country, if not others. Think about how valuable that data is, the kind of data that it's getting. Of course, it has to anonymize, but that's perfectly okay if you're trying to use the data to figure out how much more quickly and more effectively can I treat the next person who's coming to me with these facts and figures, right? But the most profound example and the biggest AI play in our portfolios is Tesla. Tesla has been collecting real world driving data. It now has orders of magnitude more real world driving data and corner cases, meaning those moments that we rarely see in driving. You and I may never have to drive in a dust storm in a desert somewhere, but they've got that data. And so Tesla is going to be in the best position to launch an autonomous taxi platform, which is going to be a winner take most opportunity. It has the domain expertise, it has the data, and it has the AI expertise. It is the only auto manufacturer that has designed its own AI chip. And really, it has taken a leaf from Apple's book. Apple redefined the market, right? While Nokia and Ericsson and Motorola were talking about consumer designs that would please the consumer, so they had turned it into a fashion item because they had done as much as they could. Apple basically redefined it as a computer in our pocket. I remember, we all know the iPhone moment. I remember, I said, wait a minute, I can get the internet on this phone? I can't believe I must have it, right? Well, Tesla's doing the same thing in the auto space. The AI this time around is going to enable autonomous driving. And so the winner take most part of this is the company that has the most and highest quality data on corner cases is going to get a person from point A to point B the quickest and the safest way. And that will be data that the Transportation Safety Association in the government is monitoring. And I'll just give you something that we just did research on. Sam Corris again did this research, and I'm sorry, Tasha Keeney did. And she learned that with autopilot and the full self-driving pilot, a Tesla car will have an accident 1 in 3.2 million miles, compared to an average car, 1 in 500,000 miles. This is data that they can prove out. So 6 times safer. Now, the real like for like is not the average car on the road. Some of them are really old and don't have a lot of safety features. It's really a Tesla car pre-autopilot. And that number is 5 times safer than the old Teslas. So, they're just pulling away from the competition in amazing ways.
Well said, definitely. And anybody who wants to see this in action, go and watch SpaceX land a rocket on a platform out in the ocean. It crashes, and then they get it right, and they get it right every single time now. So I think that's something that we can all look forward to.
Yep.
Well, Cathie, I want to give you an opportunity for any closing statements that you might have here before we turn it over to Charlie. Any last words that you could pass along to the audience to help them kind of stay the course in this difficult environment?
Well, I think, thank you, Jack, and thank you for doing this with me. I think the most important thing for me right now, investing in the markets, is understanding how thick the bearishness is out there. The short position on our flagship ETF, ARKK, hit a new record this week. It's above 25%. That tells me there is so many people are so sure that we are wrong, or so scared that the Fed's going to blow it, that they're bearish. They're max cash, they're min equities, and we think that that kind of positioning has discounted an awful lot of a hard landing effectively, and it hasn't discounted a bank meltdown, and I don't think we're going to have one, but I don't think we're 100% out of the woods. So I understand why people are concerned, but I do think that the Fed that the market will discipline the Fed. It already is, and that we will get through this, and that this period is much more like, while the Fed thinks it's the 70s, we think it's more like the 19 teens. We had a pandemic back then, it was called the Spanish flu. We had a war back then, World War I. Those were much more serious than what we've been through. This is an echo of that. Inflation, now we were on the gold standard back then and highly disciplined. Inflation, because of supply chain problems and war-related problems, hit 24% by June of 1920. By June of 1921, it was down to minus 15% because they were shrinking the money supply. I think the bigger risk here is deflation, and those who are not positioned for it are going to have problems. I think it's going to be a big problem for the value part of the market, which is very dependent on pricing, ironically, and it's going to suit our style, because our style is inherently deflationary. Our technologies follow learning curves that are expressed by cost declines over time, but this is good deflation, which causes units to boom. And I think innovation solves problems, and we're going to help get our economy and other economies out of this mess.
Very well said. Thank you again, Cathie. I encourage everybody, if you have an opportunity, consider going to the ARK websites, ark-invest.com and ark-funds.com. On ARK-invest, you can find monthly updates from Cathie covering the macro environment, economy from a monetary policy standpoint, fiscal policy standpoint, and also from a market and innovation standpoint. In addition to that, we consistently publish resources where we interview industry specialists, allowing you to gain deeper insight into the parts of the market that we are offering exposure to. So with that all said, thank you everybody for taking the time to join us. I'm going to turn it back over to Charlie.
Thank you so much, Cathie and Jack. It was a great conversation. Thanks to everyone who connected with us today. Look for an event survey to follow afterwards. Thanks so much. And with that, this concludes today's webinar.